Today, taking Australia's economic pulse. Hello again, I'm Martin North, the Principal Analyst at Digital Finance Analytics. Welcome to our latest post covering finance and property news with a distinctively Australian flavour. Today I want to discuss some excerpts from the Newgate Real Estate and Infrastructure Fund newsletter and their view that we are in for a significant economic slowdown in the Australian economy. Is a recession on the cards? And what will happen to the vital retail sector? And by the way, if you get value from our posts, please do consider supporting our work either via Patreon, here is a link, or by making a one-off donation via PayPal, again, here is a link. We really appreciate your support to help us begin to make great content. Newgate starts with a pretty self-evident statement. Australia has not had a recession for 27 years, which is a global record. But now Australia is heading for a housing-driven economic slowdown, and retail is also in the firing line. Citing MIT Professor John Sterman, they said, real estate constitutes a large fraction of the total wealth in any economy, and in turn generates a large component of banking debt. Consequently, real estate booms are often accompanied by periods of intense speculation involving expansion of credit and banking activity, stimulating the economy. When the bubble bursts, the resulting bad loans, defaults and unemployment can throw an entire economy into recession. Oh yes, indeed. And they add that until recently, Australia had all of the ingredients of a major housing market correction except contracting credit growth. But now, the revelations from the Royal Commission into the banking sector add that into the mix. And of course, the report was released to government today, and we will see it next week. The Commission highlighted the lax lending practices of the Australian banking system and has seen them become a lot more selective about who they lend to. Willingness to lend has declined. On the other hand, we also have falling willingness to borrow. The evidence points towards borrowers becoming more cautious about using high levels of debt to buy an asset that appears to be declining in value. And they suggest that the widespread commentary about forecast house price declines of 15 to 20% are scaring potential buyers and reducing their willingness to borrow. And we certainly see that in our surveys. Plus, there is ample evidence to support it. For example, net rental yields on property in Melbourne and Sydney is 2.5%. That's the lowest since 1950. Next, they highlight that the Australian banking system relies on housing like no other banking system globally. Residential loans represent about 62% of all Australian bank loans. So it's no surprise that we are where we are. Since 1977, Australian banks have grown their residential lending books by on average 13% per annum. GDP growth has only averaged 6% over that same time. And this has caused household debt compared to disposable income to move from 40% to 200%, the highest in the world. On the back of this growth, Australian banks have been an excellent investment, increasing in relative terms by 7 times compared to the average World Bank. The banking sector now represents around 30% of the S&P ASX 200 and around 50% of dividends. But as house prices fall, there is an impact on the economy as the population feels less wealthy, the well-known wealth effect, which psychologically crimps consumption. But one of the less known issues with falling house prices is reduced mobility. When house prices fall, people move less. And we saw this during the UK and US housing market corrections during the global financial crisis. Housing turnover dropped from 6% to 3%, and importantly, negative home equity reduces household mobility by 30%. Mobility matters because when people move, they spend on appliances, furniture, and other consumer durables. Lower mobility negatively impacts the retail industry, one of the major sectors of the economy. And the other major impact of falling house prices is housing construction. House prices and housing construction are highly correlated. Price is a signal, and it is communicating lower housing construction ahead. And this is an additional issue for the Australian economy. Construction is the third largest industry in Australia, producing over 8% of our GDP and employing roughly 10% of the workforce. The construction industry is also a major consumer of steel, concrete and other building materials. The feedback loops between falling finance, housing and construction will put pressure on the economy and lift unemployment, creating yet more downward pressure on household finances and the property sector. And in this environment, cutting interest rates will make no difference. Bank losses will rise, lending will continue to fall. And one other major real estate sector they are concerned with is the retail real estate. During the last recession in the early 1990s, retail rents fell, but it took 6 to 12 months after the recession for it to occur. And this is as expected because leases protect earnings in the short to medium term. They say that we should expect retail rents to contract during a recession in the Australian economy, and retail rents are cyclical. It is just that we have not observed this cyclicality over the past 2 decades because of Australia's unprecedented economic expansion. But then, of course, retail real estate is not just contending with a slowing economic cycle. Online retailing is growing exponentially as we culturally become used to using it as a method of purchasing goods and services. It has taken almost 2 decades for online retailing in Australia to reach 6.6% of total retail sales, but we think we are moving to the point where it is beginning to grow. We expect online retailing to follow the typical technology S-curve. One of the major arguments against the threat of online retailing is the human need for social interaction. And they are not denying this, but they are not calling the end of shopping centres just yet, but a contraction in space requirements and a recalibration of rents. Plus, retail landlords have had nearly 2 decades to adapt to online retailing, and we are only now starting to see any strategic responses to this threat. This obvious observation from the Boston Consulting Group from 2006, 12 years ago, said e-commerce presents incumbent bricks and mortar retailers with a serious dilemma. And they point to one of the industry's watershed moments, which was when the Lowy family orchestrated the sale of the shopping centre giant Westfield Holdings in December 2017. After many years of research and study, the Lowy family took the view that combating online retailing was going to be extremely difficult. Frank Lowy, after 58 years of growth, sold his shopping centre portfolio to European shopping centre company Unibail-Rodamco. Unibail's share price has fallen 30% since this transaction. And Macquarie Bank's research highlights that Australia is underpenetrated across a range of retail categories. For example, Australia has just 2% online penetration in grocery retailing. This compares to China and the UK at 5%. But the research also shows online grocery retailing in Australia is growing rapidly at 25% per annum. Other major categories with low penetration rates include home, garden and auto, where Australia has just a 5% penetration rate compared to a 20% rate in the UK. And in electrical and office, Australia has a 6% penetration rate versus the US at 26% and the UK at 19%. And they also cite the Merrill Lynch Global Technology team, who had this to say about online retailing. We think global penetration can increase from 11% currently to an excess of 25% over time, significant runaway for continued solid industry growth. Another of the major counter-arguments from retailers and retail landlords against the online threat is that Australia is too geographically dispersed and therefore logistically online retailing cannot work. This argument is insufficient because it does not consider that an online retailer can choose to only serve the high-density areas in Australia. You could argue Australia's density is perfect for online retailing penetration because over 85% of Australians live in urban areas and nearly 70% live in our capital cities, making Australia one of the most urbanised countries in the world, says the ABS. So to gain a glimpse of what may happen to Australian retail landlords, they looked at the United Kingdom, and in the UK, e-tailers' top-line revenue growth has been hampered by just over 2 years of negative consumer confidence, rising consumer credit, and rising indebtedness, a poor economic backdrop. These factors are conspiring with rapid online growth to cause foot traffic at shopping centres to gradually decline over the past 3 years, with an acceleration over the past 12 months. The impact is severe. The UK shopping centre company Hammerson trades at a 40% discount to book value, and the stock price has fallen 40% over the past 6 months. And in response to market pressures, Hammerson had management consultants McKinsey undertake a review that made 2 observations. Firstly, Hammerson should increase exposure to high-growth retail categories and reduce weighting to outdated and disrupt concepts, such as department stores. And Hammerson should steer the tenant base towards formats such as healthcare, co-working and logistics. But McKinsey suggested strategies for Hammerson is obvious and appealing, but unlikely to be effective. Their analysis suggests that there are not enough new Amazon-proof tenants to offset the vacancy created by outgoing or contracting tenants, and they estimate that 50 to 60% of current shopping centre space is threatened by online commerce. A major component of this space is apparel, the highest rent-paying category and representing about 30% of total shopping centre space, as evidenced in a very recent Macquarie report that illustrated the results of a major survey of retailers. They took 30 detailed responses, which in aggregate represented at least 2,300 stores, and store network rationalisation is set to continue, with 24% indicating an intention to decrease space over the next 12 months, with 21% indicating more than 10% of network space. A space contraction of this magnitude will have a material negative impact on rents. And the other way landlords will try to stem this exodus is by paying incentives, basically paying tenants to stay vacated. Either way, this will likely reduce the value of retail real estate assets, and rent reduction is only a short-term solution for the retail shopping centre industry as online retailing continues to evolve and improve, particularly on the logistics front. At an extremely simplified level, they see the industry playing out over time like this. Retail rents will fall and shopping centre values will fall with them. Shopping centre owners will find themselves undercapitalised. Debt providers will want debt levels reduced. Not all will be able to deal with this and will exit the industry. Many operators will not have the skills and capabilities nor the capital to remix and reinvent their shopping centre and will exit the industry. The new owners of shopping centres will be operating a markedly different asset. Shopping centres will comprise much greater entertainment and experimental areas, and there will also be much greater mixed-use activities such as hotel, residential and office. So if you stand back and think about it, you can see that housing and the retail sector are both pushing in the same direction, and that direction is negative. Whether in fact it will turn to recession, we'll have to wait and see. But nevertheless, it's clear that the forces are definitely down. If you found this useful, please do like the post and add a comment or question. I read them all. And if you've already subscribed, thank you. I really appreciate your support and participation. And if you haven't yet subscribed, please do so to receive future alerts. I'm Martin North, the Principal at Digital Finance Analytics. Many thanks for watching, and I'll see you next time.